Welcome to Mastering Interest Rate Derivatives and the lecture titled Valuation of Interest Rate Swaps and Swap Use Cases. My name is Tim Glauner. Before we begin, I'd like to briefly address copyright and trademark considerations. In this course, we will delve into the topic of interest rate swaps. Initially, we will provide an overview of what swaps are and their function. Following that, our discussion will turn to the cash flows associated with interest rate swaps, including both fixed and floating rates. We will then proceed to valuation techniques. It's important to understand that the value of an interest rate swap can be determined as the sum of its discounted cash flows. We'll also consider the role of collateral in valuations. In the third segment of today's lecture, we will explore various use cases for swaps. We will examine how they can offer economic benefits due to comparative advantage, their application in hedging bond issuances, and finally, how a swap dealer might create a synthetic treasury bond return. Additionally, we'll discuss how these deals are funded and hedged. So this will be an intense lecture. There will be no complex mathematics, but some complex logical concepts in this lecture. Let us start with an overview of interest rate swaps. The primary objective when engaging in an interest rate swap, including managing exposure to fluctuating interest rates, using swaps as a hedge against such risks. Swaps are also used to adjust the duration or other metrics within a portfolio through synthetic deals, which minimize transaction costs compared to outright buying or selling of instruments in the market. Another objective may involve exploiting market discrepancies through arbitrage, since swaps have specific exposures that can be leveraged if there are perceived differences in market expectations. Lastly, some may engage in swaps purely for speculative purposes. Consider this example. Company A and Company B enter into a contract where Company A, the payer, agrees to pay 3% fixed on $100 million periodically, while Company B receives this 3%. In return, Company B pays SOFR plus 75 basis points to Company A. This arrangement is not at the money. If it were, the fixed rate would be set against SOFR without a spread. Likely one party requested either to pay or receive 3%, resulting in an implied spread so that the initial value of the swap is minimal. Now let's move on to discussing interest rate swap cash flows. We illustrate swap cash flows for a transaction as of October 2nd, 2023. Here you see annual timestamps along a horizontal timeline with our spot date being October 4th, 2 days from now. Subsequent years are marked out until 2028. We observe 5 annual fixed rate flows below the timeline and 5 floating rate flows above this timeline. The first floating rate period begins at our spot date and extends 1 year forward. The first floating rate flow is smaller than the fixed rate flow due to an upward sloping yield curve, which implies initially higher fixed rate flows than floating rate flows, as the fixed rate is roughly the average of the floating rates adjusted by the time value of money. As we progress through time steps, you'll notice varying levels for floating rate cash flows, while fixed payments remain constant. This illustrates how parties exchange fixed versus floating flows within an interest rate swap agreement. let's delve deeper into fixed and floating rates themselves. The fixed rate is established at inception. It's agreed upon upfront and usually set so that the trade value at inception is zero or very small. The fixed rate remains constant throughout the life of the deal, regardless of market fluctuations. Because it is fixed, it carries inherent market risk, as fixed rate flows values change with shifts in interest rates. Conversely, because floating rates reset periodically based on current interest rate levels, they carry less market risk, since any changes in interest rates directly affect and adjust the floating rate coupon payments for these legs. When considering callable structures embedded within swaps, there exists additional value due to optionality. When making a swap callable, the call option affects its initial zero valuation. Then adjustments must be made accordingly by altering the fixed rate so that they reflect both non-callable components plus any option premiums involved. Imagine your vanilla trade has a 1% fixed rate. Then, assuming the call option is worth 10 basis points, then the callable swap would be quoted at 1.1% to keep the deal value of the swap near zero at inception. Now, there are some structured products that are complicated, and sometimes in the first period they offer you what you might call a teaser rate. Sometimes these X basis points that the structure yields additionally throughout the life of the deal are all bundled into the first period, so that people feel like they get this big coupon even if it's only 1 to 2 years. It's not uncommon that this is pitched to retail clients. The fixed leg also drives the naming convention. If you pay fixed, it's called a payer swap. Otherwise, it's a receiver swap. The fixed side indicates whether it's a payer or a receiver. It differs among different trading desks what it means when buying a swap, but for specific desks there might be an implied meaning of buying or selling a swap. The floating rates differ from fixed rates as it changes throughout the life of the deal and resets periodically. These are often referred to as rate resets. For instance, if you have a 5-year deal with annual payment periods, then every year the floating rate resets. It often includes a spread, as seen in some examples. If the fixed rate is at the money, you simply pay fixed versus floating. However, if your client wants to have a specific fixed rate that isn't at the money, let's say they want a 4%, 3%, or even 2% swap, then you will add a spread to the floating rate payments to accommodate this request. The actual future rates aren't known until they have reset. Therefore, projecting forward rates becomes crucial in swap trading. Additionally, indexes used for floating rates can include special features such as resetting in arrears or advance or having formulas in the payoff definition. Resets can also be structured differently. Averaging always has to be done in arrears because you don't average something when you don't know future rates beforehand. Moving on to valuations. The swap value is the sum of discounted cash flows. Valuation involves calculating present values for all cash flows using curves for projecting forward rates and curves for discounting purposes. The projection index can, but is often not the same as the discount index. Determining the indices utilizes two completely different methods. The projection index is the contractually agreed upon index on the trade. The discounting index is the index that the pricing model methodology of the bank chooses to price the trade. For each period within both fixed and floating legs of the swap, one must know start and end dates, along with fixing dates for rates which could vary. Fixing rate sources which determine the rates are looked up are defined in the swap confirmations. Calculating forward rates and cash flows, which later become reset rates, requires knowing payment dates, notional amount, and day count conventions. Days divided by either 360 or 365 or some other basis. A complex topic and outside the scope of this lecture is the fact that non-vanilla elements in the payoff definition require convexity adjustments explained well in Hull's book. This convexity adjustment often is calculated with a closed form formula, which has some volatility component. Generally, swaps, especially non-callable swaps, lack volatility components though. A common example of such a convexity adjustment requirement was a LIBOR swap that was reset in arrears rather than in advance. It was called a floater in arrears. Finally, once present values for individual cash flows are calculated by summing them up, one arrives at the overall value of their deal. As an important comment, I'd like to mention that the actual discount index is closely linked to the collateral that is posted for the swap. It might also have a credit component. We'll explore further this topic a little later. For illustrative purposes, consider a comprehensive cash flow schedule, which represents one side of the transaction, specifically the fixed leg that disperses payments on a semi-annual basis. The schedule is organized into columns delineating each interest rate period with corresponding start and end dates. These dates determine the length of each interest rate period. Notably, there can be variations in the number of days per period. For instance, the fourth row shows 179 days instead of the typical 180. This discrepancy arises when adjusting for holidays or weekends that may fall at the end of an interest rate period. January 30th, 2021 might have been such a day in this example. To determine this number of days calculation, you need to follow the basis convention discussed in an earlier lecture. The calculation for cash flow involves multiplying the rate by the number of days and dividing by the basis before applying it to the notional amount. Essentially, rate times basis times notional. Following the flow is the payment date, number of days to today, and then the zero rate, the discount factor, and the present value of the flow. Let me remind you one more time that the zero rate is the continuously compounded interest rate with a basis of actual 365, which can be applied consistently across all currencies and all markets. As a side note, I'd like to mention that some practitioners, especially on the buy side, prefer valuing deals as of their spot date rather than as of today. In this course, but also most often in practice on a trading desk, we value everything as of today. When terminating a swap though, note that the termination payment occurs on the spot date, so seeing the value today as of spot is in some situations good to see. So summing up present values of individual fixed rate flows yields your fixed leg's total value. Conversely, when looking at quarterly LIBOR-based floating legs, which are simpler than so far as there's no averaging, you will notice a similar table structure, but with additional reset dates, typically 2 business days prior to each period start. The rate column in the floating rate cash flow table shows that except the first rate, all the other floating rates are projected and slightly upward sloping. The first rate, 4.9%, was reset on January 29, 2019 and is therefore fixed. All the other rates have reset rates in the future and need therefore projection. Fixed rates approximate an average of projected forward floating rates, after accounting for discounting among other factors. Again, we calculate flows using rate times basis times notional, resulting in positive flows as we're receiving for floating legs. It might be beneficial to organize these calculations in an Excel spreadsheet for clarity and ease of manipulation. After determining payment dates and discount factors, using zero rates again, we sum up all flows to ascertain total swap value. What you see outlined above is a standard 3-year swap cash flow schedule, encapsulating all critical components neatly. Moving forward with our discussion on collateral as well as its impact on valuations. Collateral impacts discount factors used to price interest rate swaps. In our discussion, you will see that the collateral determines the index used for the curve for discounting. Interest rate swaps that are not cleared through an exchange are bilateral agreements where counterparties can default. The credit risk stems from potential losses if your counterparty defaults, while your position holds a positive value within the swap arrangement. Prior to 2008's financial crisis, counterparty risk was somewhat overlooked with minimal collateral requirements, since unencumbered trading facilitated market liquidity and profits. Post-crisis revelations underscored that even prominent banks were exposed to significant credit risk, prompting widespread adoption of collateralization practices through CSAs, credit support annexes. Cleared swaps emerged subsequently, reducing direct bilateral exposure by interposing exchanges as central counterparties demanding collateral themselves, thus ensuring less credit risk for cleared swaps. Not all swaps can be cleared though, as the exchanges require some form of standardization and the swap market requires still a lot more flexibility than the exchanges can provide themselves. I would like to bring to your attention a concept known as SIM, which stands for the Standard Initial Margin Model. This is a specific calculation methodology that can be delved into in greater detail if there is interest. Please feel free to send us a message if you would like us to dedicate an entire class or some part of a new class to this topic. SIM involves calculating certain sensitivities and inputting them into a calculator, which then computes the initial margin across various risk factors for all the different deals. This process bears some resemblance to other models, such as standardized approach of the Fundamental Review of the Trading Book, FRTB, and even Value at Risk, VAR, which utilized was called a delta VAR calculation. In derivatives trading, it's not uncommon to see certain concepts being repurposed. SIM is an important model that used in practice and is a regulatory requirement for all the banks except the smallest. For banks above a certain size, especially the swap book size, calculating the initial margin using SIM is mandatory. Now let's shift our focus to interest rate swap valuation and its relation with collateral. Please understand that this discussion pertains specifically to how collateral is factored into valuations rather than general collateral processing and management. When posting collateral, one typically earns interest on it that the counterparty pays, or when receiving collateral, you need to pay the interest to the counterparty. Nowadays, cash collateral usually accrues interest at the overnight rate. For instance, in the United States, this would be the SOFR rate. The other common type of collateral is bonds, and the interest accrued may vary, but for the sake of this discussion, we assume cash collateral is posted. To accurately value these swap flows, one must apply mathematical rigor and consider what currency the collateral is denominated in. If no CSA, the collateral support annex, is in place, then typically the bank's funding curve is used for discounting purposes. If your CSA matches the currency of your flow, say you have a USD denominated flow with USD collateral, you would discount using SOFR, as SOFR is the interest rate earned on the collateral. If your CSA currency differs from that of your flow, for example having a euro denominated swap with USD collateral, you need to use what is known as a cross-currency basis curve for discounting purposes. We haven't covered this extensively yet, but may explore it further in an advanced session or deep dive course since it's quite complex. For now, you should be aware that there is a cross-currency basis curve and beware of this terminology. Additionally, there are principles of transitivity applied within these calculations. If there is an established relationship between USD and Euro, and between Euro and Canadian dollar rates, this implies something about how USD should relate to Canadian dollar rates when discounting. When multiple CSAs allow for different types of collateral, such as Canadian dollars or US Treasury bonds, the concept of cheapest to deliver comes into play and adds another layer of complexity. To summarize, the primary point is here that when CSA currency aligns with the flow currency, that's predominantly what occurs to discount with the rate the collateral earns interest, on which is usually the overnight rate. And when they differ, the cross-currency basis curve applies for discounting. What's essential for students who are quantitative, but also it's somewhat tricky to understand why these practices exist. I will present now a rationale grounded in no arbitrage arguments based on how interest is earned on posted collateral and how it influences the discount rates. Let me illustrate. We will show that discounting is dependent on the interest rate earned on collateral. We assumed in this illustration collateral earns SOFR. Suppose Bank A will receive $100 from Bank B in 1 year through their derivatives contract. The present value of this future payment depends on applying an appropriate discount factor, what we denote as DF 1 year. Bank A will pay this amount as it's the price of $100 times the discount factor for a flow in 1 year. Bank B must post collateral equivalent to 100 times this discount factor. Subsequently, Bank A pays interest on said posted collateral at SOFR rates as contractually agreed upon with Bank B that Bank B earns over time. Ultimately, Bank A receives the $100 after 1 year and returns the collateral. Now, if the discount factor deviates from 1 over 1 plus R, where R is based on SOFR over 1 year, then, theoretically, one could generate profit as one of the banks. As we know, arbitrage should not be possible and typically isn't feasible in markets where deals are fair valued. Let's pause here for a few seconds to reflect on this example. Consider altering the discount factor and explore how Bank A or Bank B could profit if that were not the case. As this arbitrage argument can be quite confusing, I would like to guide you to explore yourself the arbitrage argument, so as a practice exercise. It's quite fascinating. As a side note, try and use GPT-4 maybe, if you cannot solve it yourself. Input this example in a prompt format as text into GPT-4 and ask it to provide an arbitrage example to you based on the information of the illustration. When I tried it, it accurately provided the arbitrage scenario, how to profit if the discount factor would differ from 1 over 1 plus SOFR. I'll leave this as an exercise for you because I want you to ponder over it. If you find yourself unable to determine how the arbitrage would function, feel free to send me a message and I will clarify it for you. Moving forward to our discussion on swap use cases. Here we will delve into 3 distinct aspects: comparative advantage, hedging interest rate risk associated with bond issuances, and an illustration of how a swap dealer can effectively provide a synthetic treasury bond return along with its whole funding mechanisms in the background. Firstly, let's address comparative advantage. We understand that credit and credit ratings influence borrowing levels for companies. They have the option to borrow at fixed or floating rates. Different credit ratings allow companies to borrow at varying rates. Typically, possessing better credit offers a comparative advantage when borrowing at fixed rates. Swaps allow to reduce costs for both borrowers if the comparative advantage is not symmetric, and the companies are indifferent to borrowing at fixed or floating. For illustration purposes, imagine 2 companies with different credit ratings. They are indifferent between choosing fixed or floating rates as payments. Company A has a AAA rating and can borrow at 4% or LIBOR minus 10 basis points, while Company B is rated BBB and faces higher borrowing costs both for fixed 5.2% and floating rates, LIBOR at 6 plus 60 basis points. Now you will now see how swaps do their magic and reduce borrowing costs for both parties involved. Let's repeat the table of the borrowing costs and how the 2 companies can borrow outright. Through an interest rate swap arrangement between these 2 companies, or potentially facilitated or likely facilitated by an intermediary bank, Company A agrees to pay LIBOR to Company B, while receiving a fixed rate of 4.35% in return. They both pay to the investor the rates in the table. After netting out their respective payments and receipts through the swap agreement, Company A effectively borrows at LIBOR minus 35 basis points, a savings of 25 basis points compared to the original LIBOR minus 10 basis points. Whereas company B ends up paying out only 4.95%, which is less than the initial rate of 5.2%. So they both benefit. This magic arises from exploiting differences in comparative advantages. The spread between fixed-rate borrowing costs is greater than that of floating-rate costs by about 50 basis points across these two companies. Both companies benefit from leveraging their relative strength in either fixed or floating-rate environments due to market inefficiencies previously exploited by investors who received higher returns as a result. Before moving on to our second use case regarding hedging interest rate risk for bond issuances, let's take a brief pause. Let's look at the next use case. We will discuss the interest rate risk of a fixed rate bond issuance and the ability for the issuer to hedge this interest rate risk by converting the fixed rate bond synthetically into a floating rate bond. The interest rate risk associated with a fixed rate bond issuance is significant. Hedging involves entering into financial instruments to mitigate or reduce this interest rate risk. A fixed rate bond inherently carries this type of risk, which you may be familiar with from mortgages or fluctuations in treasury bond values. For example, when a company issues a bond, investors provide capital. In this case, let's consider a 100 million bond issuance. The investor supplies the company with $100 million. In return, the company makes periodic payments to the investor that consists of the treasury yield that's fixed at the time of the bond issuance, plus an additional fixed 4%, which is determined at the time of the issuance and remains fixed throughout. Upon maturity, the company must repay the principal amount. However, these periodic payments are subject to interest rate risk. To manage this risk, companies can engage in an asset swap or interest rate swap to convert their fixed rate obligations to a floating rate plus a spread. Usually when a swap hedges directly a certain asset, you call it an asset swap and not just an interest rate swap, but the two are equivalent, except that an asset swap implies a hedge to a certain asset. So here's how it works. We have an investor and a company involved in regular payment transactions. Now we introduce a swap dealer into the equation. The company approaches the swap dealer to initiate a trade where the swap dealer pays the fixed treasury yield plus 4%. In exchange, the company pays LIBOR plus 75 basis points on the notional amount. This arrangement effectively cancels out the fixed rates from the perspective of the company. Now they are only exposed to floating rates and pay LIBOR plus 75 basis points. While this introduces some level of interest rate exposure due to credit risk, represented by those 75 basis points, it is significantly less than before. In theory, further hedging should be achieved through credit default swaps that transfer credit risk for an upfront fee. However, such practices are not common for such a transaction. Nonetheless, companies can layer multiple trades to eliminate various risks inherent in financial products. Asset swaps can also address complex coupon structures. For instance, callable bonds with conditional payouts or range accruals, whereby swap dealers take on specific coupon risks, fixed or complex, allowing companies more flexibility in their dealings with investors, as those risks are neutralized. It even goes further, where the swap dealer proactively reaches out and pitches innovative entire structures to companies and investors. Moving on to our third use case adds another layer of complexity. In the previous case, the dealer basically funded the fixed bond issuance with floating rate payments. Here we explore how dealers facilitate funding for fixed returns without direct bond purchases by companies seeking treasury bond returns over 5 years without actually buying bonds themselves. The process involves companies purchasing swaps that mimic coupon payments from bonds, effectively replicating bond returns. The dealer that provides the swap pays the return of the bond position by acquiring actual bonds financed through repurchase agreements, repos. This is because swaps do not require initial cash flows, while purchasing bonds demands full upfront payment. Let's examine how this operates. A swap dealer agrees with a company where they exchange cash flows periodically. The dealer provides treasury returns plus 12 basis points while receiving LIBOR from the company. Again, the dealer exchanges flows with the company. The swap dealer will access two markets, the treasury bond market and the repo market. To fund or hedge its position, the swap dealer buys treasury bonds, using them as collateral in repo markets for borrowing funds equivalent to their value. $100 million in our example. Therefore, securing cheap financing due to collateralization benefits. All the transactions happen at the same time at the initial of the trade. Specifically, the dealer buys the bond in the treasury market for $100 million and funds the cash amount by borrowing in the repo market. The dealer receives the bond and passes it through as collateral to its repo counterparty as collateral. The ownership of the bond does not change, as the dealer still requires the performance of the bond. The repo counterparty charges LIBOR minus 21 basis points for the loan. The funding rate is relatively low as the loan is collateralized with a treasury bond. Please take 5 seconds now just to absorb this information before we delve into what aspects cancel each other out from the perspective of our swap dealer. So the 100 million cash flows cancel out, the LIBOR flows cancel, the treasury bond returns cancel. Finally, when the repo matures, possibly after rolling multiple times, the collateral is also returned. Ultimately, everything within this complex financial interaction cancels out except for certain costs, specifically a payment of 12 basis points for the swap deal and an additional payout of negative 21 basis points. As a consequence, net earnings from this deal amounts to 9 basis points. It should be noted that these figures are merely illustrative and serve to conceptually demonstrate what occurs during a swap transaction. Let us recap our discussion. We began with an overview of interest rate swaps, elucidating their nature and how their cash flows operate. particularly regarding fixed and floating rates. Subsequently, we delved into how one might value such a swap by summing up discounted cash flows, which involves indices both for projection and discounting purposes. We also discussed collateral and explored how to determine which curves should be used as the discount index. Additionally, we presented 3 practical use cases. First was the standard comparative advantage scenario, often taught in business schools. Second was hedge bond issuance, where an investor issues a fixed rate bond that can be converted into a floating rate bond through bank facilitation to mitigate risk. The third was from a dealer's perspective, showing how dealers can generate returns on treasury bonds by paying them out to customers while funding their purchase through repurchase agreements in the treasury bond market, ultimately earning a small spread on these transactions. I trust that this session has been informative and illustrative of complex financial mechanisms at play within swap deals. Given that today's class was quite intense and packed with information, I encourage you all to review your slides carefully and revisit any graphs and concepts for better comprehension. Should you have any questions or require further clarification on any point discussed today, please don't hesitate to comment below or reach out directly via messages or email. I look very much forward to seeing you all in our next class session. Thank you very much for your attention and participation.